So the loan estimate, we have a sample of the loan estimate on page 168. One of the first things you need to know is, where is my rate lock? Where does it tell me that I'm locked in? On the first page of the loan estimate, on the top right corner, it will say if you're locked in, and it will say when your lock expires, okay? Above that, it's gonna give you a loan ID number and the type and the purpose of the loan. To the left at the top of the loan estimate, you have the date it was issued. Remember, it's good for 10 days. You have the applicant's name, the borrower, the property address, which is security for the note, and the sales price. You drop down to the first section where it says loan terms. You have the loan amount. Next, it says interest rate. That is your note rate. If I was you, I'd write right there in the sample, note rate. That is not the APR. Okay? Then it's going to show you what the monthly principal and interest payments are. Below that, if there's a prepayment penalty, it will say yes or no. Most loans do not have prepayment penalties unless they're subprime or hard money. Balloon payment, yes or no. Most loans, again, do not have balloon payments unless they're hard money or subprime. The next section talks about projected payments. From years 1 through 7, if you have mortgage insurance, that's when they estimate you will keep your mortgage insurance, the first 1 to 7 years. Then it shows years 8 through 30, subtracting off the mortgage insurance. Remember, you're only gonna have mortgage insurance if you put less than 20% down or it's a government loan. The next section is your estimated taxes and insurance. How much money you're paying for your property taxes and your homeowner's insurance, which is also included in the payments above. And finally, at the bottom of the page is your estimated closing cost. Below that is your estimated cash to close. The reason they show the difference is the cash to close includes your down payment. Because back in the day, they used to tell the client, this is how much you need for cost. And then they would forget to add the down payment, and they'd be like, wait, I thought I only needed 8,000, I need 16. That's a pretty big difference. Going over to page 2 of the loan estimate. At the top of page 2 of the loan estimate, these are the fees I taught you, are the fees that you should know. If you should know the fees, they cannot change. So if you're learning how to be a loan officer, you might want to write inside your loan estimate right there where it says loan costs, these fees cannot change. So you're going to know that section A, page 2 of the loan estimate, those fees cannot change. If you're a buyer and you're wondering why your loan estimate is different from your closing statement, match these fees up. They cannot change. The next section down, section B, services you cannot shop for. Circle the word cannot, because if your client cannot shop for them, you cannot change them. So these fees cannot change. Services you can shop for. If your client can shop for them, they may shop to a different escrow company you never used before. You don't know what their fees are going to be. So those fees can change by a collective amount of a maximum of 10%. So in that section where it says services you can shop for, I would put 10% plus or minus. Then they're going to add up those fees for D where it says total cost of A, B, and C. And then to the right on the top of the same page, it says taxes and other government fees, recording fees and other taxes. And then it says transfer taxes. The recording fees are in the 10%. So next to recording fees, I would put the 10%. And taxes, transfer taxes cannot change. The reason you guys have to know that are preparing to take any kind of national test is they're going to ask you what fees can change and what fees cannot change. You need to know them. Where it says prepaids, remember that the prepaids can change by any amount because they can change depending on what day you're going to close. If you were supposed to close on Monday, but you're not closing until Thursday, you're going to have about 3 more days of interest, principal, taxes, insurance. So it's going to change by a lot. On the other hand, if you close a couple days earlier, it might be a little bit less. So where it says prepaids, I would write any amount because the prepaids can change by any amount. The cool part is when you see the closing disclosure, it'll show you the items that can change and the items that cannot change, and if they changed or they didn't change. Got it? And then the rest of the escrow, the rest of the loan estimate, it says other costs and fees, and they're going to calculate the cash to close. And then it's going to match at the bottom of page 2 to the bottom of page 1. So you have that 16,054, it will auto-populate together so it all matches. On the last page of the loan estimate, this is where it shows you the real gist of a loan, okay? So don't worry about those banks losing money right now, because here it goes. It says in 5 years, they're going to show you what's going to happen in 5 years. In 5 years, this is on a $160,000 loan, right? Yeah, $162,000 loan. So imagine on a bigger loan. In 5 years, you paid $56,582 in payments. That's what you actually paid. What went to your principal? A whopping $15,773. Your APR is 4.274. When you send out the closing disclosure, if it's a regular loan, it can only change by 1/8. If it's a non-regular loan, an irregular loan, it can change by up to 1/4. If your APR on your loan estimate is more than 1/8 higher on a regular loan, then you have to redisclose and wait 3 more days. Okay? Total interest percentage. Over the life of the loan, the interest of the total interest percentage on a $162,000 loan is 69.45%. So like I said, don't worry about the banks. Appraisal. This is where you disclose to your client that they get a copy of their appraisal 3 days prior to consummation at no extra charge. They've already paid for the appraisal. You cannot charge them extra for a copy of their appraisal. Next, they're going to disclose if the loan is assumable. Currently, most loans are not assumable, so it should say not assumable. The next thing it's going to disclose to your borrower is that they have to have homeowners insurance on their home. The bank is taking a huge risk lending money to somebody with a home. If the house burns down, they want to be paid back. So the homeowners insurance has to be shopped for prior to closing the loan. They will not release the funds. I don't even think they'll give you your docs until you have the homeowners insurance picked out and the lender is noted as loss payable. So if the house burns down, the lender gets their money first. Homeowners insurance. Late payments. If you pay your house payment after the 15th day, they're going to charge you 5% of the payment. Not 5% of the loan amount, 5% of the payment is a late fee. Refinances. By getting this loan, your future may change and you may not be able to refinance in the future. Servicing. This is where they tell you if they intend to service your loan or sell your loan. At the bottom of the page is where your client will acknowledge that they received the loan estimate and sign it. And at this point, after they sign it and send it back to you, if they say they intend to move forward, then you can get the credit card for the cost of the appraisal and move forward. You guys all got that? And that's your loan estimate. So let's go back to the page where it says loan estimate on page 167 and look at the loan estimate, and I'm going to go through the same stuff in writing. Okay?